You are listening to the Money Machine Podcast with Nicole McBee. Real financial conversations and advice on how to get your money right.
Welcome to the Money Machine Podcast. I'm your host, Nicole McBee. We're having real conversations and giving great advice on how to get your money right. Today, Happy New Year. I have the amazing Jayson Thornton from Thornton Tax Firm. Jayson is an enrolled agent, but let me not give away too much. I'll allow him to tell you all about his credentials and everything about his services. Jayson, tell us about yourself.
First, thank you very much for having me on the podcast.
You're
very
welcome.
Excited. Well, what I do, I'm an accountant and I specialize in tax law for individuals, small businesses, and nonprofit organizations. My credentials come from my bachelor's degree and also my license with the Internal Revenue Service to represent clients with power of attorney representation rights. So what does all that mean? There's different levels when it comes to tax preparation. First, you have a tax preparer. That's someone who you would go to, and normally they would collect all your tax information, all your documents, and basically put numbers on the forms where they should go, and they would produce a tax return. The second level would be a tax accountant, someone who does more than just put the numbers on the forms, but then they have the ability to also produce financial documents for someone who has a small business or depending on what type of wage earner you are. Then the third level would be a tax advisor. That's where I find myself at, where I have the ability, of course, to collect the information, put the numbers on the form, produce financial documents. But at the next level, I can also represent you before any tax authority to resolve any issues that you may have. So that's where I come from in my aspect as a accountant.
Okay, excellent. So the enrolled agent piece, what does that mean? It just sounds like James Bond.
Right. Well, in the world of accounting, there are only two quote unquote licenses. There are many credentials, but there's only two licenses. The CPA, the most well-known one, is a license by the state. All 50 states and the territories have a license for certified public accountants. And there's two avenues when it comes to that license. There's one, the tax side, and then there's audits. Audit is when you basically investigate a individual or a business's financial statements and you see if they're following the proper accounting rules.
Okay.
Now, an enrolled agent is specifically only tax. So that's the difference between the CPA and the EA. The CPA has the ability to either practice tax or practice audit, where the EA practices tax.
So also tell me this, Jayson. So with the EA, you're not there's no boundaries by state.
Exactly. That's another main difference. A CPA is bound to practice within the jurisdiction where they have their license, and that's either going to be by the state or U.S. territory. While the EA is a federal license, and you can practice anywhere you want, have any client from all over the world, and that's another advantage.
Excellent. So tell me, if a person's looking for a tax professional, why an EA? I mean, you pretty much summed that up, but most people are so used to hearing the word CPA, and it's like, oh, I want to, contact my CPA, and it's like, okay, yeah, that's great, but here's Jayson, he's the EA.
Right. The main difference and the main advantage would come from when you hire someone that has the EA credential and license, you know you're getting a tax professional.
Excellent.
Now, I am a member of many different accounting boards and accounting associations, and I have friends who are CPAs and enrolled agents and just tax preparers. But at the end of the day, most of my friends who have the CPA license do not practice tax. So there's no guarantee just because you have CPA behind your name that you actually practice tax. Okay. While when you get an EA, there's 100% you're getting someone who is licensed to practice tax. Not only fill out the forms, not only produce financial statements, but also represent you before the government.
Okay, excellent. So I would at this time ask you, about your wife and your dog and your cat and all that great stuff. But it's 2018. We're at the beginning of the year. We have new tax laws on the books. Most people are confused.
Yes.
The ink hasn't even dried. And I put out, some questions. I had some questionnaires and asked some of my business clients and some friends and family members real specific things. So let's get into the crust of this. What does this tax reform mean to businesses and also individuals?
Right. First and foremost, I want to make sure that they understand that what you did from January 1st, 2017 through December 31st, 2017, it's still going to be going under the original tax law that we had before the new law came into effect. So I don't want you to get too excited or too worried about trying to comply to the new law, because that's not what we're handling right now in the 2018 tax season. The new law is in effect now since January 1st. So your business activity from now to December 31st, 2018 is what's going to be applied to the new law. That's first and foremost. All right. This new law is called the Tax Cuts and Jobs Act. What this did is really change up what tax law has been for the past few decades. And I want to go over some of the main points of changes that are probably going to affect your audience. Number one, their tax rates and the brackets have changed. They were originally 10%, 12%, 22, 24, 32, 35, 37. That's what the old tax rate brackets. Now it's 10%, 15. No, let me reverse that. I went in the wrong order. The old was 10, 15, 25, 28, 33, 35, and 39.6. The new is 10, 12, 22, 24, 32, 35, and 37. What does that mean? The tax bracket that you were currently in is probably going to be less this year. That's what that basically
so
means.
I essentially, I think I was in about 15%. Right. And so now that means I can potentially go down to 12?
Yes. All things staying equal. If you were originally in 15, you're probably going to be in 12.
I'm
if
over
you
here
were
doing a happy dance.
25, you're probably going to be in 22. So that's the general concept.
Okay.
Now, also what's going to affect a lot of families is the doubling or near doubling of the standard deduction. Now, I don't want to get too deep into the weeds when it comes to the complicated things of this, but basically there's standard deduction, there's itemized deductions.
Okay.
A lot of people are going to fall under the standard deduction, especially since it's nearly doubled. So if you were a person who were barely making it to itemized, you're probably going to take the standard deduction, because for a individual, it was originally $6,350 for this year, 2017. Next year is $12,000.
Okay.
Right. So if you were barely breaking that threshold from standard deduction to itemizing, you're going to be itemizing. For a married filing joint, it's $12,700 for 2017. Next year is $24,000.
Okay.
And there's a lot of people who are kind of on that edge. And for people who file head of household, this year, 2017, is $9,350. Next year is $18,000. So if they were barely breaking it when it comes to making the threshold to be able to itemize their deduction, they're going to be taking the standard deduction next year.
Okay. A couple of things that I know that impact me personally. Mortgage insurance. Mm-hmm. Can we still get the mortgage credit?
We're still getting we're still getting the things before. There was a threat out there that they were going to try to take away the itemized deductions altogether. Mm-hmm. That didn't go through. Okay. So we still get mortgage interest deduction. We still get the state and local tax deductions. The only difference there's going to be is there's some caps in certain areas.
Okay.
Originally, there was no cap for state and local
So is
taxes.
it a $500,000 cap for the mortgage interest? What was the mortgage interest cap?
Mortgage interest cap off the top of my head, don't remember.
No worries. I know the ink hasn't dried on this. So, and I continue to say that as we're going to get into, the thick of it.
Got it. Mortgage interest. Okay. Originally, it was $1 million.
Right.
Okay. It actually was reduced with this new law to $750,000.
Okay.
When you get into that range, you're doing okay.
Okay.
But it was $1 million down to $750,000.
Okay. So yeah, there was rumor of this $500,000. You see how confused we are?
Yeah.
And I'm like, wait a minute, that impacts me and my portfolio, because mortgage interest is important to me. Also for my audience, the child care credits.
Yes, the child care.
It was a child care credit. Mm-hmm. Then there's also there's lots of single moms out there that are super concerned about earned income credit.
Right. The earned income tax credit, same as it was before.
Okay.
The same qualifications as it was before. So I wouldn't be worried about that. Now the child tax credit.
Okay.
The child tax credit was increased from $1,000 to $2,000.
Okay.
Now there is one little catch to it. The refundability of that $2,000 is up to $1,400.
Okay. So what does that, for those of us who are not tax savvy, what does that mean to a person, a lay person?
Yes. So a tax credit basically gives you dollar for dollar reduction of the amount of tax that you owe. So in the past, if you owed $1,000 in tax, you got a $1,000 tax credit for the child tax credit. That would zero out your balance. You wouldn't owe anything.
Excellent.
But let's say you didn't owe anything from the beginning and you got this $1,000 tax credit. That means that you would get refunded back that credit of $1,000. With the new law, let's say you owe $2,000 in tax. Now the child tax credit has been bumped up from $1,000 to $2,000, so that would zero out your balance. But let's say you owe nothing in 2018. Instead of getting $2,000 back for refundability, you can get $1,400 back to be able to refund it. So you get the full credit. So if you owe, you get a full $2,000 credit to pay off that debt. But if you go over where you do a refund, they will only refund up to $1,400 per child tax credit. So if you have 2 children, you would be getting $4,000 worth of tax credit, but you'd be getting $2,800 worth of refundable tax credits.
Excellent, excellent. You're listening to the Money Machine Podcast. I am your host, Nicole McBee, and right now I have in the building Jayson Thornton from Thornton Tax Firm. Jayson is an enrolled agent, and he is sharing with us some great information on the 2018 tax reform, the jobs and tax reform. I know I have a few friends who've received, they're anticipating their $1,000 credit or their bonus check from several of the major corporations. I believe, was it Southwest Airline?
Yeah, I mean, there's a lot of big corporations that have been throwing out a lot of big numbers about what they're going to do. Personally, I would sit back
and wait.
Don't get too excited. One of the biggest things I want to make sure that your audience is aware of is to not go out and change your W-4 withholding because you expect this big tax cut, right? You want to keep your withholding exactly where it is. The tax law is what has changed. So you don't need to change your W-4. This means if you had 3 allowances because you have 3 dependents on your tax return, it should continue to just have 3. Don't change it to 2 or 1 or none because you think this big tax cut is going to help you out. The tax law is going to take care of itself. Don't run out and try to change your W-4 withholdings.
So, Jayson, my concern, and as I talk to people who have been around a very long time, my grandfather, my uncles, a couple of my mentors, they're saying, hey, Nicole, just wait. It's been a long time since we've had any type of reform in the tax code. So we're waiting. We're truly anticipating what's going to happen. It doesn't seem like we really, really know. How well versed or the H&R Blocks and the Jackson Hewitts, or is no impact at all of this go around?
Well, yeah, this go around, it shouldn't be that big of a deal. We're still going off of the old law. So for this year, 2018, for a tax season of a tax year of 2017, there shouldn't be that big of a difference. But when we're looking at tax planning, thinking forward, not looking back, that's where the difference really comes in of how versed people are in the new law and how much are they being updated with the new law. Do they have a different job outside of tax season, or is this something that they do all year round? Especially if you are a small business owner, you want to be looking forward because there's a lot of provisions in this new law that could potentially help someone who is self-employed if they position themselves in the right way.
So when you say that, this segues us right into smart money moves. Mm-hmm. So when we talk about smart money moves, as a business owner, what are some of the top 2 or 3 things that they could do to position themselves?
Well, It really depends on how they're organized.
Okay.
All right. So there's things that we consider as pass-throughs. You might hear that a lot on the news when they talk about the new tax law. But a pass-through entity is basically a type of company where the owners of the company take on the tax liability. What type of company is that? Is it like a self-proprietor, someone who wholly owns the company by themselves? Then there's partnerships, right? A partnership does not pay tax. Partners pay tax, right? So these are flow-through entities. With this new tax law, there's a provision where flow-through income to your personal tax return is going to receive a 20% tax decrease. So what that does is if you made $100,000 in your business, be it a partnership, be it a sole proprietorship, you're only going to be taxed on $80,000 of that $100,000 moving forward. So you want to make sure that you're taking advantage of these deductions. Now, a C corporation is the only entity where that corporation, that business, actually gets taxed itself, right? And then those owners who receive money from the company, they get taxed on the money they receive. So you fall into a position where you're getting double taxed if you have a C corporation. So you really want to sit down with your tax advisor and really take a look at where you are currently and if you're positioned to take advantage of the new tax law.
Okay. So I get a lot of people run by and they're like, oh, I want to do an LLC. What do you advise? Because an LLC is not going to be perfect for all parties.
Well, yeah, it just really depends on their personal situation. Now, an LLC in the world of tax, an LLC is considered a disregarded entity.
Correct.
An LLC is for civil litigation. It's protection. It's so where if someone attempts to sue the company and they win an award, they can only go after the assets in the company. Right? So the IRS looks at it as a disregarded entity. So you can be a LLC sole proprietor. You can be an LLC partnership. But when it comes in the terms of tax and the Internal Revenue Service or the Department of Revenue, you're still just a sole proprietor or a partnership because they don't care about civil litigation. They're just looking at the numbers.
Okay, excellent. Next question, and this was actually a question from a great friend of mine and sorority sister. She wanted to know about starting new business in 2018. There was some benefits for starting a new business, things that you could write off, tax planning and moving forward. What can be done for new businesses and startups?
Well, with the new law, there's no big difference between starting a new business if you started in 2017 or if you started in 2018. It's really the difference of the taxation towards the end. So the benefits of starting a company and the things that you can write off, that has not changed. You can continue to write off the expenses that you incur while attempting to start or while you're attempting to create income. I mean, that does not change with the new tax law. The advantage is if you're starting the business in 2018, that means you're going to get the advantage of taking the 20% deduction of your taxable income.
Oh, wow.
But honestly, most of the time, that new business may not make a profit in that first year. And when you don't make a profit within that first year, some people ask me, and I just had someone in the office earlier today who asked, do I need to file? I didn't make any money. I kind of just started the last few months of the year, and I didn't make any money. Should I file? And I always say, yes, of course, because that loss that you took in your business allows you to deduct from the positive income that you received from other sources. Because most small business owners start out their business with one foot in the door with their job and the other foot out the door working on their business. So as an example, if you made $40,000 with your job, but then lost $5,000 in your business, you're not going to be taxed on the full 40, you'll be taxed on 35. You take that advantage of having that deduction.
Excellent. One more question. I kind of, again, put this questionnaire out to quite a few people. Had one young lady said, hey, I filed bankruptcy. It included my past federal and state debt. However, the state is now coming back demanding payment. What's going on and how do I get this resolved?
This situation happens a lot. And the very first piece of advice that I would say is you need to re-engage with the attorney who handled your bankruptcy. That's the first piece. Because what could have happened was if the debt wasn't fully discharged, what type of bankruptcy was it? What type of agreement did they have with the Department of Revenue, with the IRS? You could have just simply been on hold from collection activity during that time and not actually have settled that debt. Because what most people don't know is the Internal Revenue Service has a statute of limitation of 10 years to collect the debt.
Oh, wow.
While the Department of Revenue, at least for the state of Missouri, there is no statute of limitations. As long as they're a valid balance, they can come after you. So I would encourage your friend to, one, re-engage with the attorney that she had to handle the bankruptcy and get a good understanding of what was going on with the Department of Justice. Was it really being discharged, or was it just a hold of collection activity?
Okay. Excellent. So we always want to talk about how to avoid some pitfalls. So some financial failures. What are some common financial failures do you find both personally and also from the business aspect?
Number one, not keeping proper records, especially for business owners. The excitement of owning your business can sweep you off your feet. I mean, you think about it for a long time before you ever pull the trigger. Then when you pull the trigger, you're swept up in the activity of actually doing what you do to make money, right? So actually sitting back at the end of the day or the end of the month, going through your bank statements, looking at your receipts, looking at your invoices, and actually crunching the numbers does not make you money unless you're an accountant. That doesn't make you money. You actually have to be out in the field or whatever you do to make your money. But not keeping proper records is going to kick you in the teeth at the end of the day because it's hard to recreate documents.
Oh, absolutely. And there's so many apps and so many QuickBooks and there's so many, tools out there that helps you maintain your records and keep them in great order.
Definitely. I mean, one of the most simplest things that they can do is make sure that they run all revenue and expenses through a business bank account. I mean, there's apps that you can connect to your bank account that will help categorize and track all your income and track all your expenses. But even the most lay person who's not very tech savvy, if you just simply make sure that all the money that comes into your business flows through the bank account and all your expenses come out the bank account, at the very least, you can always point back to a bank statement and we can try to create some financial statement based off the bank statement.
Okay. Personally, financial failures.
Personally, it's really not keeping up with a budget. Most people got a good gut feeling about how much money it takes to pay off their bills at the end of the month. They got a good gut feeling. But what they don't do is actually create a budget that outlines the amount of money that it takes to cover all their bills, right? How much they're going to spend on more leisure activity, and then how much they're going to save. If they actually create a budget, and it doesn't have to be punishing, right? If you get into a month where you had a budget where you're only going to spend $250 on entertainment and things of that nature, and you want to do something a little bit more fun, and you go over that budget, that's fine. But until you have some sort of framework, a budget that you can look at and you know that my rent and mortgage is going to be covered with this, my utility bills are going to be covered through this is how much money I should spend on eating out. And when you go outside of that budget, you can kind of look and see why you're always underwater, right? And it also helps you predict and plan things for the future, right? It will help you guide your ambition of things that you want. Because if you don't have a budget, then you're really just shooting from the hip and you think you have enough money to cover this new expense. But then at the end of the month, you realize you really don't.
Right. So definitely. So you were saying, hey, record keeping is a financial failure for businesses.
Definitely.
creating a budget is a financial failure on the personal side.
Definitely. You have to have a budget. When you see that brand new car and you think to yourself, well, if my current payment's $250, I get that brand new car, it's only going to be $350. It's about $100 a month more.
They never count in
I
the
want
sales
that car
tax
right.
and,
I want that car
insurance.
more than just $100 more a month, so I'm going to go get that car. But you're not really taking into account the full range of expenses that you have every month that would probably help guide you a little bit better than your emotions of wanting that new car. Okay. It really just comes down to setting up a plan for the things that you want and taking care of your obligations.
Gotcha. So if a person owes taxes, what's the first thing they should do? Because a lot of times people, they'll pull a Wesley Snipes and they'll just ignore it, and the letters will continue to roll in, and then they kind of get amnesia about it.
The worst thing you can do if you are in a tax problem is to ignore the notices that come to you. Ignoring the notices are going to put you into a deeper hole than it would be if you just face it head on, right? A lot of these notices have timelines attached to it. There's deadlines. There's 30-day deadlines, 45-day deadlines, 90-day deadlines.
Oh, wow.
And what ends up happening is if they send you a notice that has a 30-day deadline and it's a notice of intent to levy. A levy is the government seizing your property, taking what you have. And the number one thing they're going to do to take what you have is put their hands into your bank account or go to your employer and put their hands into your paycheck. You had a deadline of time that you could have stopped it from happening. You could have communicated with the Internal Revenue Service, set up some sort of payment plan on your own terms instead of them going into your bank account and taking it all out. So let's say you have saved away $12,000.
Okay.
And you owe $30,000 worth of tax and you didn't follow up or respond to any notices. While you could have simply set up a 72-month payment plan for that $30,000 debt, you ignored all the notices and the IRS put their hands into your bank account and took everything out because what you owed is more than what was in the bank account.
Right.
And you getting that money back is little chance to none. While you could have just simply set up a payment plan. The only thing I can do to help you at that point is set up a payment plan for the remaining balance. Because the action has already been took. The only way that we can try to get some of that money back, if I can go before the Internal Revenue Service at some hearing and plead your case on some sort of financial hardship. And even then, there's no guarantee. So you have to be proactive when it comes to having these problems. And I know it can be extremely devastating. It can really be frustrating and depressing. But the longer you wait and the longer you ignore, the bigger the hole it is going to be for you to get out of.
Okay. Is that the same with both federal and state? I know most people don't want to engage the Department of Revenue, especially in Missouri.
Right. The state are bigger gangsters than the Fed. And let me explain why. We already talked about how the federal government has a statute of limitation of 10 years and the state does not have a statute of limitations. You have to also realize that the federal government is far, far away from where you are and the state government is right here at home. The state government has the authority to enforce trying to collect tax by dealing with your licenses. If you're someone who is licensed through the state,
that's what I wanted you to share.
They can revoke your license, your ability to make the money that you had originally. They can go in and affect things like student loans. You do not really want to get too deep when it comes to the state. Also, when it comes to settling a tax debt, the Internal Revenue Service has a much more streamlined process when it comes to settling a tax debt. While the Department of Revenue, at best, I'm going to be able to reduce penalties, interest, but you're not getting pennies on the dollar the same way that you can get with the Internal Revenue Service. I mean, they're really, really more stricter on what you can do with a settlement. So when it comes to the state of Missouri, the Department of Revenue of any state, you really want to make sure that you are proactive when it comes to dealing with tax issues.
Excellent, excellent. So, Jayson, we are drawing close to getting W-2s and 1099s. A lot of those are going to be out here by January 31st.
Yes.
So people will be looking for tax professionals to assist them. So I definitely recommend that you call Jayson. But Jayson, give them your information, your contact information.
Definitely. My phone number, office number is 314-394-8588. You can always email me at jthornton@accountant.com. My office is located right in downtown St. Louis at 1409 Washington Avenue at St. Louis, Missouri 63103.
Excellent. Thank you so much, Jayson. It has been a pleasure.
Yeah, I mean, honestly, the time went by fast. I thought, I was like, there's no way that I'm be able to fill up this amount of time.
We had lots of more questions.
With boring tax law, but it happened.
You know what? I find myself, staying close to what's happening in the world. And one of the big things that's going on right now is taxes.
Oh, definitely.
And people want to know, how is this going to impact my life? How does this impact my paycheck? How does it impact my business? And I believe that you have definitely shed some light on the situation. So I do thank you so much. You're listening to the Money Machine Podcast with your host, Nicole McBee. Hopefully we've given you some real advice and an excellent conversation. Thank you and have a great day.